What is a 1033 exchange? A 1033 exchange is very similar to a 1031 exchange in that it allows a taxpayer to defer any capital gain from a property that was realized as a result of an involuntary conversion, which means that the taxpayer did not intend for the property to be lost or be sold, but had to lose the property or sell the property under compulsion. And such compulsion might include eminent domain. That is compulsion by the government, or major disaster such as fire, earthquake, hurricane, or flood that cause a total destruction or even partial destruction of the property in question. Certainly, compared to 1031 exchange, you are not likely. Hang on a second, I don't think I record this yet. Just a moment. Oh yeah, it is recording, isn't it? That's good. Okay. Now compared to 1031 exchange, you are less likely to come across a 1033 exchange than if you than 1031 exchanges, simply because this type of misfortune only happens to a small number of people. But it doesn't hurt to know how to do a 1033 exchange and what advice you need to give to your client on a situation where you can actually provide your services to help him look for a replacement property. If you find out either one of your clients or their relatives or even strangers or prospects who had just suffered losses due to involuntary conversion, you may want to offer your services to help them save some taxes. Saving only in terms of capital gain deferral. They don't really they are not really saving on any tax in terms of tax-free exchange. A 1033 exchange is not a tax-free exchange. It's a tax-deferred exchange, just like a 1031. One distinction. What did I do? Hang on a second. I need to go back to my earlier slide. Apologize for that. Okay. Now it is restricted to sale of properties that suffer from involuntary conversion. It is not a tax-free exchange, but a tax-deferred exchange. How does 1033 exchange differ from a 1031 exchange? Number one, as we all know, when you do a 1031 exchange, no part of the proceeds of the sale of the relinquished property can go into your possession. Every single part of the proceeds have to go through a qualified intermediary, or you don't have a valid 1031 exchange. However, on a 1033 exchange, it is just the opposite. You do not need a qualified intermediary. If you're wondering what a qualified intermediary is, it is just a neutral. Generally, the qualified intermediary is a company that has no relationship to the taxpayer, such as a title company that has a 1031 exchange division, or a 1031 exchange specialty company that they will do nothing but provide qualified intermediary services to the customer. However, for 1033 exchange, no QI is required, which means once a disaster occurs, the money that the taxpayer receive from the recovery of the insurance proceeds doesn't have to go through a qualified intermediary. The insurance company can send a check to the taxpayer, and the taxpayer can cash the check and keep the money in the taxpayer's bank account without losing the eligibility of doing a 1033 exchange. So that is a big distinction between the 1033 exchange and a 1031 exchange. Another distinction between 1033 exchange and 1031 exchange has to do with the type of the nature of or characteristics of the replacement property on a 1033 exchange. We know that on a 1031 exchange, the standard is like for like. What like for like really means is the relinquished property must have been used for trade, business, or investment, and then the replacement property must also have been used for trade, business, or investment. For example, on a 1031 exchange, the relinquished property can be a gas station, and gas station is characterized as one that is used for business or investment or both. You can actually exchange a gas station for an apartment complex, because an apartment complex is also one that is used for business or investment. That's the definition of like for like. So in the case of 1031 exchange, like for like doesn't mean gas station for gas station, nor does it mean rental property for rental property. You could have a vacant land that is relinquished, and a replacement property, a property such as a gas station or apartment complex. The use may be different, but the reason for the ownership is the same. It is being used for trade, business, or investment. That's the standard for 1031 exchange. For 1033 exchange, the standard is a little different. The replacement property must be of similar or related in use. Strike out all use. Similar or related in use. Okay? Which is different from the like for like standard. The only time you can use like for like standard on the 1033 exchange if the involuntary conversion is due to eminent domain, such as the government wants to build a railroad track through your property, wrote a letter to you and asked you to transfer or sell the property to them. That is an eminent domain situation. Only in eminent domain situation where you can use the like for like standard. In all other situations, the standard is similar or related in use. I will further define similar or related in use in a subsequent slide. But bear in mind that the similar or related in use standard is actually more restrictive than the like for like standard. And there's another distinction between 1033 exchange and 1031 exchange that has to do with the amount of time the taxpayer must close escrow on the replacement property. As you may recall, on the 1031 exchange, the deadlines are very strict and they are very tight. On a 1031 exchange, you have to identify the replacement property or properties within 45 days. and then to close escrow on the replacement property within 180 days. It is very strict because there is no exception. There is just no way you can ask for an extension when it comes to the 45 days and 180-day deadline. That deadline is pretty rigid. 1033 exchange follows different deadlines. Here it says the taxpayer has 2 to 4 years from a defined date to acquire replacement property, depending on the manner of laws. I will explain to you a little bit more what I mean by manner of laws. When I say manner of laws, I am referring to whether the loss was a result of natural disaster or was it a loss that was as a result of eminent domain. If the losses are different, the replacement period may be different. And there's another restriction for 1033 exchange. For 1033 exchange, the replacement property cannot be acquired from a related person. Okay? So you cannot acquire a property that is owned by an ABC corporation and you have ownership interest in that ABC corporation. Let's say, for example, you are an individual. You own a commercial property and let's say you own a commercial property. You lost it through eminent domain. Now you want to do a 1033 exchange. And you look around, there is one property that is held by a corporation in which you have stock ownership. If that is the case, you may not use this property as a replacement property. So the replacement property cannot be acquired from a related person. The word person here actually includes entity. How much time does the taxpayer have to find replacement property? It is not 45 days, nor is it 180 days to close escrow. It is a different standard. And it is actually not quite fixed because the replacement period begins on the earliest of the date of disposition of the property or the threat of imminence of condemnation. Let me explain to you what that means. Sometimes a taxpayer may receive a letter from the government making threats that they are going to take over the property through eminent domain. That letter, that threat starts the replacement period. Or if a property is lost through a natural disaster, that is the earliest date where a taxpayer can find a replacement property. That's when the replacement period starts, from the day he lost the property through natural disaster. Whereas in the case of eminent domain, the replacement period doesn't start from the day the government takes over his property, but it starts from the day he receives that threatening letter from the government. So it's the earliest of the two, okay? So you figure out which is the earliest date. You just pick that date to be the starting date for the replacement period. And then when does it end? The court say it ends 2 years after the close of the first taxable year in which any part of the gain upon the conversion is realized. Later, you see an example of how I do the computation. That way you know how to apply it. So it starts from the earliest of the two possible dates, which is the disposition of the property or the threat of imminence of condemnation. That is when you receive the letter from the government about eminent domain. And then it ends 2 years later. Not 2 years later, though. I'm sorry, I have to correct myself. It ends 2 years after the close of the first taxable year in which any part of the gain upon the conversion is realized. That's a bit hard to understand, but once you see the example, you know what I'm talking about. And another thing that is different between 1033 exchange and 1031 exchange is that in the case of 1031 exchange, there is just no way you can ask for an extension. You miss the deadline, you miss the deadline. Whereas in the case of 1033 exchange, the taxpayer may apply for extension of time to the IRS, of course subject to the IRS approval. That is an option that a 1033 exchange taxpayer has that a 1031 exchange taxpayer doesn't have. Example 1. Here's an example on how to determine the deadline to close on the replacement property. Example 1. The government wrote a letter to taxpayer to take his property by eminent domain, and that letter was written on February 15, 2014. After the taxpayer received the letter, and under threat of eminent domain, the taxpayer agreed to sell the property to the government on June 15, 2014. So the taxpayer did not get the money immediately. The taxpayer received payment from the government on February 15, 2015. So the question, when does the replacement period end and when does it begin? Let's talk about when the replacement period begins. The replacement period begins on the date that is the earliest of the disposition of the property or the threat of imminence of eminent domain. The property was disposed of after February 15, 2014, but the threat came from the government on February 15, 2014. Therefore, the replacement period begins on February 15, 2014. The end of the first taxable year in which gain is realized is December 31st, 2015. How did I determine that? You look at the day that the taxpayer actually received payment. He received payment on February 15, 2015. Therefore, he realized the gain on February 15, 2015. And then the code says the end of the first taxable year in which gain is realized. Taxable year in which gain is realized is the 2015, and the end of that taxable year is December 31st, 2015. The tax code says the 2 years starts from the end of the first taxable year and ends 2 years later. So you add 2 more years to the December 31st, 2015. Therefore, the replacement period ends on December 31st, 2017. So the taxpayer in an eminent domain case actually has more than, from the time he received the letter from the government to the time when he has to complete his purchase, it's actually more than 2 years. It's not 2 years because it depends on when he realized the gain. He had not realized the gain until he had transferred the title of the property to the government and until after he has received payment from the government. Example 2. This taxpayer lost his warehouse through an accidental fire. Taxpayer filed insurance claim and received payment from the insurance company on June 15, 2014. When does the replacement period start? The code says the replacement period starts Actually, there's something wrong with this example. This replacement period should start on the day he lost it to the accidental fire. So I don't have a date here, assuming that he lost it on February 15, 2014. Okay, let me go ahead and insert that missing date here. But he did not get paid. Actually, when I was drafting this example, I meant to put down February 15, 2014 as the date he lost it. And then June 15, 2014 as the date he got paid. Because he lost the warehouse on February 15, 2014, the date of disposition of that property is therefore February 15, 2014. So the correction on this example would be that the replacement period begins on February 15, 2014. Now, he received payment on June 15, 2014. If he received payment on June 15, 2014, he must have realized his gain in the taxable year of 2014. So 2014 was the first taxable year in which gain is realized. And the code says the 2 years starts from December 31st, 2014, and then it ends on December 31st, 2016. Example 3. Taxpayer lost his warehouse through a major earthquake. President declared the area a federal disaster area. Taxpayer filed insurance claim and received payment from the insurance company on June 15, 2014. And again, there's an error here on example 3 that I'll try to correct here. The example should have stated taxpayer lost his warehouse through a major earthquake on February 15, 2014. And then the president immediately declared the area a federal disaster area. The taxpayer filed claim but received payment from the insurance company on June 15, 2014. Assuming you accept my correction on example 3, the replacement period therefore begins on February 15, 2014, and not June 15, 2014 as stated in error in example 3. And because the taxpayer actually received payment from the insurance company in the taxable year of 2014, therefore, the end of the first taxable year in which gain is realized is December 31st, 2014. Special rule applies when you lost a property through a major disaster in an area where the president has declared the area to be a federal disaster area. In that situation, instead of getting 2 years, you're getting 4 years. So the 4 years will put us on December 31st, 2018. So that is the last day for you to close escrow for the replacement property. So this is how you will calculate the replacement period. It's a lot longer than the 180 days and even the 45 days. Notice we don't worry about identification of the replacement property within a deadline. That is not a concern on the 1033 exchange. You will qualify for 1033 exchange as long as you close escrow on the replacement property within the replacement period as calculated based on the different situations. Next, we need to understand what does it mean to have similar or related in service or users. It must be similar. The replacement property must be similar or related in service or users, or it does not qualify for 1033 exchange unless the eminent domain exception kicks in. So in general, the replacement property follows a stricter standard of similar or related in service or uses. Replacement property must have physical characteristics and end users similar to those of the converted property. The more straightforward one will go something like this. Rental property. For rental property, if you lost a rental property through either natural disaster or eminent domain, and you want to take advantage of 1033 exchange, the most conservative way to do the exchange is to find another rental property. For example, rental property doesn't mean if you lost an apartment complex, do you have to look for an apartment complex? Not necessarily. If it's a rental property, such an apartment complex, you can actually do a 1033 exchange for a commercial rental property. The fact that one is residential, one is commercial, doesn't change the fact that it is similar or related in service or uses. You see, when you own a apartment complex, even though it's being used by residential tenants, your whole reason, the main purpose of your owning the apartment complex is that you wanted to derive rental income from the property. On the other hand, if you own a commercial, let's say, strip mall, your whole reason or objective to own the strip mall is to derive rental income from that property. So for your property that was lost through involuntary conversion, it was being held to derive rental income. That's the apartment complex. And then for replacement property, it's a commercial strip mall. It's also being held to derive rental income. So it does fit the criteria for similar or related in service or use criteria. Therefore, you can qualify for 1033 exchange, apartment complex for strip mall. Now, on the other hand, if you have a vacant land that has no structure on it and is strictly used for investment, it's being held for long-term investment and not for any kind of rental income. For years, all you do is just pay property taxes on it. You hope that in time it would appreciate in value. You derive no rental income. Can you then exchange this vacant land, let's say, for a parking lot? Now, vacant land for parking lot, it's a little tricky because I think an argument can be made that a vacant land could be a parking lot. When people use vacant land as parking lot, they hold title to this property for two reasons. Number one, they might be holding title to it to derive income, such as parking fees, rental income for parking fees. Also, they could also be holding title to the property, to the vacant land for investment purposes. So I think there may be enough of an overlap between the vacant land that is strictly held for investment and a parking lot that is held for both investment as well as rental income. So I think in this case, vacant land for parking lot might be okay. But if it's vacant land for that is held for investment for, say, for example, apartment complex, then you got a problem. Because I think predominantly, though, when you own an apartment complex, it's mainly for the rental income. That's the example that I just gave you. Another distinction between 1033 exchange and 1031 exchange is that for 1033 exchange, you can actually decide if you want to do any tax-deferred exchange or not during the replacement period. So during the replacement period, if you do not tell the government that you want to realize the gain, in other words, if you don't tell the government you want to pay tax on it, the government assumes you want to defer the tax on the capital gain. Okay, so you have a very long period of time in which to decide if you want to pay tax on the capital gain or you want to defer your capital gain. So you got plenty of time. Unlike a 1031 exchange situation where you only have a very tight window of 45 days, because if you think too long, you miss 45 days deadline, you lose your chance to do a 1031 exchange. Whereas in the case of a 1033 exchange, you can have either 2 to 3 years or 3 to 4 years or 5 years to think about it, depending on what situation you are in. And the basis of the replacement property, the basis of the replacement property shall be the same basis as that of the converted property. Just like in the 1031 exchange, when you do a 1031 exchange, the basis of the replacement property is the same as the basis of the relinquished property. So there is very little difference between 1033 exchange and 1031 exchange when it comes to computing a tax basis. There are certain rules that apply in a 1033 exchange situation. We have applied one of these rules earlier in one of the examples. In a presidential declared disaster areas, the replacement period is extended to 4 years after the close of the first taxable year in which any part of the gain upon the conversion is realized, as illustrated in one of the examples that I discussed earlier. You got 2 extra years if the president declared disaster area. Now, since I'm talking about this special rule, I think it is important that I point out another distinction between 1033 exchange and 1031 exchange. There's something unique, not unique, but there's something about 1033 exchange that you don't find in 1031 exchange, is that if you own a single family residence as owner-occupied at the time of the loss and not as an investment property, in other words, your single family residence is not being held as an investment property. Under ordinary circumstances, if your single family residence is not being held as investment property, in other words, it's not being used as rental, it does not qualify for 1031 exchange. Now, let's say, for example, you live in your own house. Actually, this scenario can happen to any one of us. Accident may happen. A strong earthquake comes and demolish your home. You have suffered a complete loss to your home through a major disaster, and the president declared your property is located in an area where it's a president declared disaster area. Even if it is a single family residence that's not being held as investment property, you may still qualify for 1033 exchange. Okay? Now, in other words, whatever capital gain that you get, they will still recognize that 121 exclusion. If you don't remember 121 exclusion, that is the one that allows a property owner who uses a single family residence as primary home to exclude the first $500,000 of the capital gain from the proceeds of a normal sale for husband and wife. But this is not a normal sale. A taxpayer has just lost his primary residence through a natural disaster. This taxpayer will definitely not qualify for 1031, but the taxpayer can still qualify under 1033 exchange. What that means is, if you had a house that you bought 30 years ago for $200,000, at the time of the loss, it was valued at $1 million. Assuming that you are able to get $1 million insurance check from your insurance company, your tax basis was $200,000. The market value of your property was $1 million. Therefore, the IRS will take the position that you realize a capital gain of $800,000. Of the $800,000 that you just realized, $500,000 is still excluded under Section 121, even though the loss was involuntary, even though there was no sale that actually took place. Furthermore, the excess, the surplus $300,000, can be deferred to the replacement property. If you lost a house through a major earthquake, and it doesn't have to be presidentially declared disaster area either, assuming the president did not declare the area a federal disaster area, and you just lost it, total loss, and it's $1 million. And if you do not put any of the $1 million insurance proceeds in your pocket, you look for another replacement property and buy the replacement property for $1 million. In that case, you can still defer the entire $500,000 and the surplus of $300,000 to the next property. The only thing to pay attention to is that your basis, your new basis on the replacement property is not $200,000. Your new basis, because you have that 121 exclusion, the $200,000 original basis, you have to add $500,000 to the $200,000 to account for that 121 exclusion. So the new basis for your replacement property then would be $700,000 and not $200,000. Therefore, it is not like in a 1031 exchange where you have investment for investment. This is basically a property that was lost through a disaster, and you can still take advantage of 121 exclusion, even if it was lost through disaster. Next, if property is converted by eminent domain, then the like-for-like rule for replacement property is similar to 1031 exchange shall apply. I think I explained this already, right? In one of the examples I told you earlier. This is about the only time where you can apply the like-for-like standard. Now, in the case of single-family residence that was lost, so even though it wasn't held for, it was a situation where it was not held for rental income, you can still exchange it, but then it is not eminent domain, so you don't have that, and plus you can't really get another investment property anyway. So if you lost a single family residence that you use as a primary residence, the next property would have to be a property that you're holding as your principal residence if you lost your principal residence through a natural disaster. If property is lost through disaster in a presidential declared disaster area, then the like-for-like test similar to 1031 exchange may be used. Now, earlier I said for single-family residence, you can only exchange it for single-family residence. That is true because you can't do a single-family residence held for primary residence and then exchange it for an apartment complex. You can't do that. But on the other hand, for a commercial property, for example, that is being held for investment, and then the earthquake came, and then the commercial property is demolished. If the commercial property is demolished in the presidential declared disaster area, even if the loss is not through eminent domain, there is an exception that allows you to use the like-for-like test as in the case of 1031 exchange. For example, you own a strip mall that was lost through an earthquake, and then the president declared the area to be a federal disaster area. You can then exchange that strip mall for a gas station, for example, or for something else that is not similar in use or service, but that will qualify under like for like. Something else that could be held as property that's held for trade, business, or investment. So something to keep in mind. All right, that concludes today's presentation. And I thank you all for joining me.